Hello and welcome to this edition of Staying Ahead of the Curve. I'm Jeff Snyder, Vice President, Senior Consultant with CAMAC Retirement Group, and I'm pleased to be joined today by Michael Grupe, Executive Vice President for NAREIT. Michael, thanks for joining us on the show today.
Jeff, it's a lot of fun and a pleasure to be here with you.
So I know we want to talk about REITs, and we're going to get to that in terms of the conversation, but you've had a very interesting, you have a diversified background. You work for the Federal Reserve, and I wanted to get your assessment of the current market conditions and also the potential for a for rising interest rate environment. So I'm wondering if you could take the audience through your perspective.
Oh, I'd be happy to. As you mentioned, was at the Federal Reserve Board in Washington for a number of years early in my career. And so that provides a little perspective that one does not easily forget. This goes back to the late 70s and early 80s when Chairman Volcker had come on board. And so what I remember from that time was accompanying high inflation were 30-year Treasury rates at 15 7/8. The prime rate was at 21.5. So when I look at the current interest rate environment, and I see very little indicators of inflation. I see relatively slow, though positive, economic growth. I'm not too worried about the likely direction of interest rates in the near to intermediate term. And I'm particularly not too concerned about the possibility of the Fed raising policy rates by 25 basis points or 50 basis points when I remember 15 7/8 and 21.5. So from my perspective, I understand why the market is focused on Fed policy. It should be, it's important. I understand, I believe, the concern about the direction of interest rates, but I don't see it as a major issue in the investment markets today. I would also point out that at our rate of growth at 1.5% to 2%, we are doing better than much of Asia, much of Europe. When you look around the globe, interest rates, if anything, seem to be moving lower, not higher. So I just don't see the signs out there that a credit tightening is either needed or warranted, or that the cost of credit is going to materially rise in the near term.